Welcome to the Book Recap Show. And within it, welcome to the Deep Dive, where we unpack complex topics, sift through the noise, and bring you the clearest, most actionable insights. Today, we're plunging headfirst into something, well, really fundamental for everyone: personal financial planning. Our mission for this deep dive is basically to distill essential insights from a comprehensive source, helping you understand how to build your own financial roadmap. It's about gaining clarity and control over your money without getting bogged down in jargon.
Absolutely. And that clarity, it's never been more crucial. If we connect this to the bigger picture, the financial landscape has shifted pretty dramatically. Think about it. Fluctuating inflation, turbulent stock markets, global economic changes.
Yeah,
They're constantly reshaping the terrain.
right. Things feel less predictable.
Exactly. And many countries, including places like India, are also seeing increasing pressure on social security systems because populations are aging. That means more responsibility is landing squarely on your shoulders to plan for your own future.
So what exactly is personal financial planning then? Is it just budgeting?
It's much broader than just budgeting, though that's part of it. Really, personal financial planning is, let's say, a process of developing a personal roadmap for your financial well-being. The inputs are pretty straightforward: your current finances, income, assets, your specific goals.
Like buying a car or retiring?
Precisely. Buying a car next year, retiring comfortably in 30 years, whatever your goals are. And, importantly, your comfort level with risk. The output is a clear, actionable plan. And this isn't just theory. It gives direction and meaning to every financial decision you make.
Okay.
It helps you understand how each choice impacts other areas. It allows you to adapt to life's inevitable changes more easily. And, ultimately it provides a greater sense of security and peace of mind.
That sense of control definitely sounds appealing, especially when things feel so uncertain out there. So to give you that control, we probably need to start with some foundational concepts, right? The bedrock stuff.
Yes, exactly. Understanding the basics is key.
Okay, so here's where it gets really interesting, I think. One of the most fundamental concepts is the time value of money. It sounds a bit academic, maybe, but it's profoundly practical.
It really is.
The core principle is simple. Money you have today is worth more than the same amount of money you might get in the future. Imagine someone offers you, say, $1,000, or maybe 10,000 rupees if you're thinking in India.
Yeah.
You want it now or 6 months from now?
You'd take it now.
Almost certainly.
Yeah.
Right? Why? Because you can use that money now. You could invest it, let it grow,
Yeah.
or even just buy more with it before inflation potentially chips away at its value. Yeah. That immediate access, that opportunity, gives it more value.
Exactly. And understanding that immediate value is crucial, especially when we talk about the superpower of compounding. This is where your money literally starts working for you. It earns returns not just on your initial investment, but on all the previous returns as well. It snowballs.
The snowball effect, I like that. How can we sort of quantify that, make it more concrete?
Well, there are a couple of handy rules of thumb for estimating how long it takes for your money to double. The rule of 72 is the quick one. Just divide 72 by the annual interest rate.
Okay.
So if you're earning, say, 8% a year, 72 divided by 8, that's about 9 years for your money to double. Simple. For a bit more accuracy, there's the rule of 69. It's 0.35 plus 69 divided by the interest rate. A little more complex, but slightly closer.
Got it. Rule of 72 for quick estimates, rule of 69 for a bit more precision.
Right. And the real insight here isn't just the math, it's the implication. A small, consistent saving, maybe just $100 a month, starting when you're 25, can grow into a really substantial sum by retirement. But if you wait until you're 35, you might need to save double that each month just to catch up. Time is genuinely your most powerful financial asset, even more than the amount you save initially.
Wow. Okay, so time and compounding are the engine.
Yeah.
But you mentioned risk earlier. Every engine, every opportunity comes with some risk, right?
Right.
So what does this all mean for understanding and, more importantly, managing financial risk? Because let's face it, nothing is guaranteed.
You're absolutely right. Nothing is guaranteed. Financial risk, in simple terms, is the unexpected variability or volatility of returns. Basically, things might not go quite as planned, for better or worse.
Okay, variability.
Yeah. And we can break it down a bit. First, there's market risk. This is the big one, the overall ups and downs of the market, bull markets, bear markets. It's influenced by everything from political events, economic news. even just market psychology, herd behavior.
Stuff you can't really control as an individual investor.
Exactly. Then there's business risk. This comes from the specific company or industry you invest in. Think about fluctuations in their sales, maybe their product becomes obsolete, or they have really high fixed costs. Again, mostly beyond your control. And finally, there's financial risk. This is more about how a company manages its own money, specifically its use of debt. More debt can mean bigger potential gains, but also bigger potential losses, wilder swings for the stock.
What's different types of risk piling up? Can you actually measure this stuff?
You can, yes. Sophisticated investors use statistical measures like standard deviation, coefficient of variation, skewness, basically tools to quantify how much an investment's return tends to bounce around its average. But even without getting deep into the math, just having a conceptual grasp, knowing that some investments are like a gentle wave and others are like a roller coaster, helps you compare options and see what fits your comfort level.
That makes sense, comparing the potential roller coasters. Okay, so we have the time value, compounding, and risk awareness as our foundation. Let's move into the practical building blocks then, the actual things you might put in your financial plan. What are the main investment options people usually look at?
Right, the vehicles for your journey. There's a whole spectrum. At the very safe, low return end, you have cash investments. Think savings accounts, certificates of deposit or CDs, treasury bills. They're liquid, low risk. But the catch is inflation can eat away at their purchasing power over time.
So safe, but maybe not great for growth.
Generally, yes. Then you move up the risk-return ladder to equities or stocks. These represent ownership in companies. They offer potential for higher returns through dividends and capital appreciation, the stock price going up, but they come with more volatility, more ups and downs. The key thing for long-term goals, though, is that time can help smooth out those bumps.
Riding out the waves.
Exactly. Then you have bonds. These are essentially loans you make to governments or corporations. They pay you interest, so it's fixed income. Generally safer than stocks, but usually offer lower potential returns. There are government securities, corporate bonds, even some hybrid instruments.
Okay, so stocks for growth potential, bonds for relative stability. What else?
Mutual funds are a really popular option, especially for, let's say, the common man. Think of a mutual fund as a big pool. It's a trust that pools the savings of many investors who share a similar financial goal. A professional manager then invests that pool in a diversified portfolio of stocks, bonds, or other assets.
So diversification is built in.
Yes, that's a major advantage. You get diversification and professional management at a relatively low cost, which is great for people who don't have the time or expertise to pick individual stocks or bonds. And finally, there's real estate. Buying property. This is usually a long-term commitment. Gains come from rental income and, hopefully, the property value increasing over time. It often involves leverage using borrowed money and can offer some tax advantages, too.
Okay, quite a range there. Cash, stocks, bonds, mutual funds, real estate, lots of tools in the toolbox. But just having the tools isn't enough, right? The real skill is using them together effectively. What are some key strategies for actually managing these investments?
Absolutely. Strategy is key. The first and arguably most important principle is diversification. We touched on it with mutual funds, but it applies broadly. Don't put all your eggs in one basket. Spread your investments across different asset classes, stocks, bonds, real estate, maybe some cash.
Mix it up.
Yes. And even within asset classes, so not just stocks, but maybe large company stocks, small company stocks, international stocks, different sectors. The goal is to reduce single security risk, making sure one bad apple doesn't spoil the whole bunch, and to manage overall market risk because different assets often react differently to economic events.
Okay, diversification is number one. What else?
For bonds specifically, a strategy called laddering can be useful. This means buying bonds that mature at different times. So instead of having all your bonds mature at once, you have some maturing this year, some next year, some the year after. It helps manage interest rate risk. If rates go up or down, you're not reinvesting everything at potentially unfavorable rates all at once.
Spreading out the timing, basically.
Precisely. And for equities, especially for small investors or those just starting out, the buy and hold strategy is often recommended. It's simple. Buy quality investments and hold on to them for the long term, riding out the market's short-term fluctuations rather than trying to constantly buy low and sell high, which is very difficult to do consistently.
All right, less about timing the market, more about time in the market.
Exactly. It often leads to favorable long-run returns with less stress.
What's really encouraging here is that this isn't just for millionaires. The source material emphasizes that financial planning principles apply to everyone, even first jobbers.
Right.
People just starting their careers.
Yes, absolutely. There's a great point made about protecting your wealth-making machine, which is essentially you and your ability to earn an income. And there are some really practical habits highlighted.
Like what?
First, the habit of pay yourself first. This is critical. As soon as you get paid, before you pay bills or spend on anything else, automatically put a portion aside for savings and investments. Ideally, put it somewhere that's a bit hard to access easily so you're not tempted to dip into it. It makes saving a priority, not an afterthought.
Make it automatic.
Ugh.
Out of sight, out of mind.
Pretty much. Second, investing in personal development. Allocate some funds for continuous self-improvement. This could be reading books about money management, like we're discussing now, or taking courses to boost your job skills. Think of it as investing in your human capital, your earning power. It pays dividends over the long term.
Investing in yourself is an investment. Makes sense.
And third, don't forget leisure. Seriously, you need to allocate some money for enjoyment, in moderation, of course. It helps prevent burnout and lets you actually enjoy the fruits of your labor along the way. It's about balance.
But not just endless sacrifice.
No, it's about sustainability. These habits, paying yourself first, developing yourself, and allowing for leisure, they all work together to protect that wealth-making machine and systematically build wealth over time.
Protecting the machine. I like that analogy. And speaking of protection, that brings us neatly to another crucial pillar. Insurance. Safeguarding yourself and your assets. It's like putting a protective casing around that financial engine.
That's a great way to put it. Insurance, at its heart, is about risk sharing and risk transfer. You pay a premium, and in return, an insurance company takes on the financial consequences if a specific bad thing happens, like premature death, a house fire, a major illness, a car accident. The risk is transferred from you to a larger pool.
Okay, so sharing the potential financial hit. What are the main types we should know about?
Well, the big ones are life insurance. This provides financial support to your dependents if you pass away. Often, term plans are highlighted as efficient for pure risk cover, just protection. The advice often given is try not to mix insurance and dedicated investment products usually do the growth part better.
So keep protection and growth separate, generally.
It's often more efficient, yes. Then there's health insurance, sometimes called Mediclaim. This has become absolutely critical. Healthcare costs can be incredibly high, and good health insurance protects you from potentially crippling medical bills. And finally, general insurance. This is a broad category covering things like fire insurance for your property, motor vehicle insurance, maybe marine insurance if you're shipping goods. It protects your physical assets and covers potential liabilities.
So it's really about identifying what you need to protect.
Exactly. That's personal risk management. First, identify what you have, your property, your savings, your future income potential. Then figure out what risks those assets face and how much protection, how much insurance you need for each.
Protecting your future income potential.
Yeah.
That naturally leads us to the really long-term view. Retirement planning. It can feel like this huge, distant mountain to climb, but it's something we all need to think about, right? Making sure the engine keeps running even after we stop working full-time.
Absolutely. Retirement planning is fundamentally the process of arranging your finances so you can achieve financial independence later in life. The goal is to get to a point where working is a choice, an option, rather than a financial necessity.
Why is planning for this so vital now? Haven't pensions and Social Security always covered it?
Well, that's changing. First, there's the uncertainty of Social Security and pension benefits. As we mentioned, populations are aging, putting immense strain on government systems. Plus, many companies have shifted away from traditional pensions, so the responsibility is increasingly on the individual. Second, unforeseen medical expenses can pop up, especially in later life, and they can be substantial. You need a nest egg that goes beyond just covering basic living costs.
You need a buffer.
Definitely. And third, having a secure nest egg provides flexibility. Life throws curveballs. Having financial independence gives you the means to cope with unexpected changes, which brings enormous peace of mind. And remember what we said about compounding. The early bird gets the nest egg is so true here. Starting early, even small amounts, makes a massive difference over decades.
That power of time again. Are there specific tools for retirement savings?
Yes. Besides general investing, annuities can be a useful tool specifically for retirement income. Essentially, you pay a sum, or sums to an insurance company, and they guarantee you a stream of income for a set period, or often for the rest of your life. They come in different flavors, immediate or deferred, fixed or variable, to suit different needs and risk tolerances.
Okay, so another specialized tool for that specific long-term goal. So we've covered a lot of ground. time, value, risk, different investment vehicles, strategies like diversification, the importance of insurance, planning for retirement. But for someone listening, maybe feeling a bit overwhelmed by all these pieces, what does this all mean? How do you actually pull it all together into a coherent plan? What's the first step?
It really does mean adopting a systematic process. You don't have to figure it all out at once. Financial planning typically follows a structured approach, often like a six-step methodology. Step one is determining your current financial situation. You need absolute clarity on where you stand right now. Income, expenses, assets, debts, get it all down.
Taking stock.
Exactly. Step two is developing clear, specific, and measurable financial goals. Not just save more, but something concrete like, I want to save $200 each month towards a $5,000 down payment on a car within 2 years. Or, using the Indian example, saving 20,000 euro each month to buy that luxury car of 8 lakh by next year. Be specific.
Make the goals real.
Yes. Then, step three is to identify and evaluate alternative courses of action. How could you reach that goal? Cut expenses here, invest more aggressively there, explore the options. Step four is using that information to create and implement a financial action plan. This is where you decide what you're going to do and start doing it.
Okay, make the plan and put it into action. Is that it?
Not quite. This is crucial. Financial planning isn't a one-time thing. It's dynamic. Steps 5 and 6 involve regularly reevaluating and revising the plan. Life happens. You get married, change jobs, have kids, inherit money. Your goals and circumstances change, so your plan needs to adapt too. Regularly check in and make adjustments.
So it's an ongoing process, not a set it and forget it deal.
Absolutely. And this holistic, ongoing process is often where working with a professional financial planner can add a lot of value. They can guide you through these steps and help keep you on track.
That makes sense. And as you're building and revising this plan, there's another factor that touches everything. Taxes. You can't really ignore them, can you?
Definitely not. Taxation is a critical overlay on almost every financial decision. But it's important to understand the distinctions. First, there's tax planning. This is the perfectly legal and smart arrangement of your financial affairs to minimize your tax liability. You do this by legitimately using all the exemptions, deductions, and rebates the law allows.
Using the rules to your advantage, legally.
Exactly. Then, completely different, is tax evasion. That's illegal. It's deliberately not paying taxes you owe, usually by hiding income or misrepresenting facts. Big trouble. And somewhere in a gray area, perhaps, is tax avoidance. This involves using legal loopholes or complex arrangements to minimize tax in ways that might go against the spirit of the law, even if technically legal. Regulators often try to close these loopholes.
So stick to tax planning.
Absolutely. And good tax planning isn't just about saving tax today. It often encourages productive investment because many tax breaks are designed to channel savings into specific areas the government wants to support, like retirement funds or infrastructure. Take Section 80C in India, for example. It allows you to deduct investments in things like provident funds, PF and PPF, life insurance premiums, even principal payments on your home loan and kids' tuition fees, up to a significant limit, currently 1 lakh. That directly reduces your taxable income and builds assets.
Right, so tax planning can actually help you achieve your other financial goals too.
Precisely. It's an integral part of the overall strategy.
Okay, so we plan, we invest, we insure, we manage taxes. All these actions happen within a bigger system. That brings us to the regulatory environment. Why do we need financial regulation, and who does it?
The rules of the road. Financial regulation is fundamentally necessary to ensure fairness, stability, and trust in the financial system. Its main goals are to prevent fraud and manipulation, make sure financial institutions are stable and don't pose a risk to the whole economy, and critically, to protect the interests of investors and consumers like you.
Keeping the system safe and fair for everyone.
That's the aim. In India, for instance, you have key regulators for different areas. The Reserve Bank of India, RBI, oversees banks and other non-banking financial companies. The Insurance Regulatory and Development Authority, IRDA, looks after the insurance sector. And the Securities and Exchange Board of India, SEBI, regulates the stock market, brokers, and mutual funds. They set the rules, monitor compliance, and take action when necessary.
Is there one right way to regulate?
Well, there's an ongoing global debate about the best approach, whether it's better to have very specific, detailed rules-based regulation or more flexible principles-based regulation that focuses on outcomes. Both have pros and cons. But the overarching consensus, especially after various financial crises, is that ensuring the long-term stability of the financial system has to take precedence over allowing institutions to chase maximum short-term profits without sufficient guardrails. Regulation fosters the trust needed for the system to work effectively.
Okay, so the regulations provide the framework, the guardrails, for our own financial journeys. We've really covered a huge amount today, from why planning matters, the core ideas like time value and risk, the building blocks like investments and insurance, all the way to retirement planning, tax strategies, and the regulatory backdrop. The big takeaway seems to be that proactive personal financial planning is incredibly empowering. It's about taking control, understanding your options, and consciously building a more secure future, making sure the financial engine is well maintained and heading in the right direction.
Exactly. It's about moving from being reactive to being proactive with your finances. And maybe that leaves us with a final thought, or rather, a question for you, the listener. This raises an important question. As you think about your own financial roadmap, whether you're just starting or looking to refine it, what specific financial goal or perhaps roadblock will you decide to tackle first? Is it finally setting up that automatic pay yourself first savings? Is it taking a closer look at your investment diversification, maybe reviewing your insurance coverage to make sure it still fits your life? Remember, this is an ongoing journey. Keep learning, set those specific, measurable goals we talked about, and commit to regularly reviewing and adjusting your plan. That's the path to adapting to life's changes and achieving that real sense of financial peace